Welcome to Mad Money. Welcome to Cramer. Other people want to make friends. I'm just trying to make a little bit of money. My job is not just to entertain, but to explain things. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Sometimes, out of nowhere, you just get hit by a tech lightning bolt. And that's how I felt about ChatGPT a little more than 3 years ago. What was this amazing creature? How did it write a haiku about a friend? How did it allow me to do a Mad Money-style interview with Gandhi? We found out quickly that this invention was the brainstorm of a company called OpenAI, launched on November 30th, 2022. 5 days later, 5 days, it had 1 million users. Ever since then, it's propelled the averages higher without ever coming public. Including today, the Dow gained 203 points. S&P climbed 1.55%. The NASDAQ pulled a gigantic 2.69%. Last week, we had another moment, this time from Google, which unleashed a new version of its own Gemini generative AI platform, a third version, and it was immediately hailed by many, including a perfect declaration from Mark Benioff, the CEO of Salesforce, who went on X, formerly Twitter, and posted this: "Holy ass, I've used ChatGPT every day for 3 years," he tweeted. And then it went on, "Just spent 2 hours on Gemini 3. I'm not going back." He then went on to say, "The leap is insane. Reasoning, speed, images, video, everything is sharper and faster. It feels like the world just changed again." Now, ChatGPT has 800 million users. Some would say it's the fastest growing business in history. So the idea that it could be dethroned so quickly is inconceivable. If you ask even Gemini, it would agree. Although I should point out that this chatbot is self-effacing, not boastful. It's also drier than GPT and not all that friendly. But as a regular and at times heavy user of ChatGPT, I too suddenly find myself migrating to Gemini. Normally, this kind of release doesn't mean all that much, but the stakes in this business are gigantic. Alphabet, the parent of Gemini, has seen its stock rallying furiously, a real rocket ship. It's up 68% so far this year, much of that coming in the last few weeks, as more and more people realize it was undervalued versus the other six, the Magnificent Seven. And then it went nuts into overdrive as people started hearing about Gemini 3, and then they saw it, and wow! Alphabet already had a big leg up on other challengers to OpenAI. That's because they figured out how to link Google, the search company, to Gemini, the AI company, in a seamless way. It's a remarkable feat. Many people thought there'd be a ton of cannibalization, but they just combined them onto the same page. The geniuses behind Alphabet, and I mean geniuses, managed to figure out how to take advantage of Google to build Gemini, so it was never hard to find. But it's only with this Gemini 3 that there's a real breakout in the stock. You have to understand the implications here, both positive and negative. First, the positive. Google built Gemini on the backbone not of NVIDIA, but on a proprietary chip designed with Broadcom, an unheralded $1 trillion stock that vaulted 38 points today, or 11%. It was an even bigger deal for Broadcom than it was for Alphabet, which rallied 6%. But the negatives were huge, too. OpenAI is not publicly traded. However, you can only imagine what would have happened to its stock if it were public. OpenAI is spending hundreds of billions of dollars to be number one, and its huge user base makes it the largest, regardless of Gemini's prowess. But if OpenAI's user growth were to slow, even a tiny bit, because of Gemini, well, that could be a big problem for both OpenAI and, more important, its business partners. Remember, this company has something like $1.4 trillion worth of spending commitments. In order to raise that money, though, it needs to keep growing like crazy. And it has been growing like crazy. Now, maybe OpenAI has a revolutionary version of its own product in the works. I, for one, would never write them off. Nor would I say that this news is definitely bad for Oracle, their biggest business partner. I think that Oracle, which builds data centers better than anyone, can get lots of takers for its product. It doesn't just live or die depending on OpenAI, but it is taking on a lot of debt. Still, if your business is hanging on ChatGPT, it just became more precarious. How about that? Which brings me to the most controversial alleged loser, and that's NVIDIA. This chip company reported a blowout last quarter, and its stock flew up in the morning, only to reverse and ultimately get hammered in the afternoon, finishing well off its high. The market needs its biggest stock to do well. That nasty reversal and its decline from 212 to 182 and change has been a nightmare. The numbers seemed to end when we heard that the president's once again thinking about letting NVIDIA sell chips to China. Right now, the company's not including any numbers from China in its projections. So anything that allows the company to sell in China would be huge. And that, I think, is why the stock leapt from 176 at its lows today to 182 and change. It closed up $3.67. Now, every member of the Magnificent Seven did rally. Amazon moved up 2.5%. That was a report from J.P. Morgan that did it. That report said that its retail business has never been stronger. You know, it's been a while since Amazon was valued for its retail business. For years now, it seems like the Wall Street only cares about the Amazon Web Services, which is very important and I believe is doing quite well, although I keep hearing that it isn't growing fast enough. I think the doubters are wrong. It's growing just fine. Tesla stock should have been down if you view this company purely as a car business. We heard some very damning numbers from China that would indicate Tesla's being priced out of the electric vehicle market over there. But Tesla's now about Elon Musk's vision of self-driving cars and robots, which is why it just keeps roaring. It's up 7%, nearly 7% today. I mean, this thing's incredible. Microsoft is quite muted. I mean, you just don't hear much about it right now, even as its business seems to be humming along. Probably because it's connected, yes, to OpenAI. Meta's been quiet, but it took off today, up 3% on the back of a Wall Street report suggesting the decline's overdone. I agree with that. But the biggest winner after Google may be Apple. Remember that Google pays Apple more than $20 billion to be embedded as the default search option in your iPhone? We keep hearing that Apple has stumbled in AI, but let me ask you, has Apple stumbled in search? I think a $20 billion check to allow Google to access your user base is a pretty good deal. How about another $20 billion for Gemini for AI, right? In other words, we give the artificial intelligence from Gemini to Apple, right? And you pay Apple another $20 billion. You could argue that Google won't pay it, but I think many others would love to cut that deal if they don't. Here's the bottom line. We have to recognize that Gemini is the biggest threat to ChatGPT we've seen so far. There's simply no two ways about it. Gemini's existential for OpenAI. The company, the emperor, better have something to strike back, because otherwise the narrative will be that OpenAI has no close. Let's go to Bob in New York. Bob.
Hey, Jim. Thank you for all you do in helping the small investor.
Sure, Bob.
I
Thank
really
you.
Appreciate it.
Thank you.
Jim, my question to you is Tractor Supply, buy, sell, or hold?
Well, I talked about Tractor Supply this morning on Squawk on the Street, and I felt that it had a pretty good chance to be able to make a comeback here. I know it's down a lot. I'm going to say you want to buy that one. Right? Look, we have to recognize that Gemini is the biggest threat to ChatGPT that we've seen so far. And ChatGPT better have something up its sleeve to counter. Otherwise, this problem becomes really existential. On Made Money tonight, due to the government shutdown, there's been a dearth of economic data. And with the release of new numbers coming tomorrow, I'm setting you up for what you could expect. Then Travis Kelce and Janet Parters are pushing for change at Six Flags. I'm sharing if I think it can be the catalyst that the stock needs, because it's been a loser. And close viewers know we love the off-price retailers, but what about the REIT that houses them? I'm checking in with Kimco to get a better read on the situation, so stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Tomorrow morning, we're going to get a ton of data from the government. But thanks to the shutdown, it's been a long time since we've seen many of these reports. That's why I want to prepare you for what's coming, so that you know how to interpret all this new information. First, at 8:30 a.m. tomorrow, we get the latest readings from the PPI, the Producer Price Index, one of the key measures of inflation that's watched by the Fed. When we got the September Consumer Price Index exactly a month ago, the market rallied nicely in response because inflation came in a little lower than expected, even if it was still pretty high at 3%. The PPI report, a little different. It measures the average change in prices that domestic producers receive for their goods. That makes it more of a leading indicator than the CPI. Typically, we'll get the PPI reading for a given month immediately before the CPI reading, but so far we only have the September CPI reading. It's also confusing. For the Producer Price Index, the last report was from August. Like the CPI, the PPI has generally been trending higher since the spring, although it's been more choppy. In August, it came in at a very cool 2.6%, but Wall Street was looking for 3.3%. This time, Wall Street's looking for 2.6% producer price inflation. If we get a number or something that's smaller like that, I think it'll be a huge win for the stock market because lower inflation gives the Federal Reserve more leeway to cut interest rates. But if the PPI comes in higher than 2.6, that's the bogey, it will be a negative. Remember, though, this is September's data, so it's already very much in the rearview mirror, but it can't be ignored. Also at 8:30 a.m. tomorrow, we get the latest month-over-month retail sales growth reading, also for September. Retail sales have been all over the map this year. For September, Wall Street's expecting 0.4% growth. Anything in that neighborhood should be considered a win. Similarly, at 10 a.m. tomorrow, we get the Consumer Confidence Index reading from the Conference Board, providing another small window into how consumers are feeling. That's something very different from what consumers are doing. This time, though, I'm taking it more seriously because this is one of the most current readings we're going to get, as the Conference Board's a private organization, so it didn't stop collecting data during the shutdown. This is all from data collected earlier this month. Might be a good read. Now, the Consumer Confidence Index has been trending lower since July, falling from just under 99 to 94.6 in October. This time, Wall Street's expecting just 93.4. Anything better than that is a positive surprise. Anything worse than that indicates the consumer might be feeling more of a pinch than we thought. The last important group of metrics that we'll get tomorrow are all housing related. All right. At 9 a.m., we get a few different releases related to home prices. First, there's September reading for the FHFA House Price Index, which measures changes in single-family home values across the country. Second, we get the September reading for the S&P Totality Case-Shiller 20-City Composite Home Price Index. That's the Case-Shiller Index for short, which measures the same thing just for a select group of 20 large metro areas. Lately, the housing market's been in bad shape thanks to persistently high interest rates. And don't forget what we need, lack of turnover. We need turnover to make this business, the home business, do better. Tomorrow, I'll be watching to see if the housing market's gotten so weak that we're starting to see more relief on prices. Now, that'd be a huge win in the fight against inflation. Now, the FHFA House Price Index reading has shown something interesting recently. From April to July, we saw 4 consecutive months where the month-over-month change was negative. Then we got a surprise positive result for August with a 0.4% increase. Remember, that's not what we want to see. The Fed needs lower housing prices, so I'm hoping the September House Price Index will actually come in softer than 0.1% increase that Wall Street's expecting. As for this Case-Shiller Index, we've seen, this is what's good news, a steady decline in home price growth since early last year. Crucially, year-over-year home price growth has remained positive, but it rose at a 1.6% year-over-year clip in August. That's down from 7% at its highs last year. Wall Street's looking for a 1.4% increase. Again, I got to see something lower. We get one more big housing number tomorrow. It's the October pending home sales reading from the National Association of Realtors. Comes out at around 10 a.m. This one's pretty straightforward, and it's more current than most of the data we're going to get tomorrow. Pending home sales have been erratic this year, but in September they were flat month over month. For the October reading that we're going to get tomorrow, Wall Street's expecting a month-over-month increase of 0.4% in pending home sales. If there's a pickup in pending home sales, that means the housing market's coming back to life, which actually makes it harder for the Fed to cut rates. And what housing needs more than anything are rate cuts, so I'm hoping for a bad number. Now, all that said, there are some limitations to the data releases that we're getting tomorrow. Crucially, many of the most important data points will be a bit stale because they're actually September readings that we're just getting now thanks to the government shutdown. So I don't know. I can't be too excited about these numbers. For that reason, though, you have to view the older data points, though, through the lens of what we've seen most recently. While the September retail sales report is useful, you should combine whatever you get from that report with what we heard from 100X about a week and a half ago. They said middle-income consumers have started lowering their spending intent in recent months, alongside lower-income consumers who are already showing signs of strain earlier this year. At the same time, we're now getting earnings from the nation's top retailers. We heard from several last week, and tomorrow morning alone we get Abercrombie & Fitch, Best Buy, Burlington Stores, Dick's Sporting Goods, and Kohl's. I think anything they say will be much more important than the September retail sales numbers, but I may be alone in that because the Fed doesn't look at these companies the way they should. However, the flood of economic data that we'll get tomorrow still matters for one very simple reason. The Fed holds its next open market committee meeting on December 9th and 10th. And we don't know what they're looking and thinking about in terms of rate cuts, although Wall Street's gotten a lot more optimistic about a December rate cut in the past week. But at this point, the decision looks like it's still a pretty close call. There are 12 voting members, and according to some analysts, we might be looking at a 6-6 tie. That means almost anything could tip the balance, which is why we are paying such close attention to these figures. If we get more encouraging economic data over the next couple of weeks, we can easily see the odds of a December cut come down just as quickly as they went up, and they went up like a flash. Let me give you the bottom line here. The upcoming Fed decision is why tomorrow's economic data dump is so important, even when a lot of these numbers are stale. Now at least you know what you're dealing with and how complicated the Fed's decision is going to be to reach. Get Money's back after the break.
Coming up, this stock's been riding the downhill of a roller coaster for years. But could it get a boost from new management? Cramer's looking at Six Flags next.
Can Travis Kelce, the three-time Super Bowl champion tight end for the Kansas City Chiefs, and the fiancé of the world's biggest pop star, Taylor Swift, turn around Six Flags Entertainment, North America's largest regional amusement park operator? Now, if you asked me that question a little over a month ago, I would have said, what are you smoking here? But because, you got to believe it or not, this is now a real question investors are grappling with. See, Six Flags, as we know it today, was created last year by a merger of equals between the old Six Flags and Cedar Fair, which was another heavy hitter in the amusement park space. Like a lot of people, I thought the deal was going to be terrific, but that turned out to be a spectacularly bad call. Ever since Six Flags and Cedar Fair combined last July, the stock's down a stunning 73%. God, that's awful. What went wrong? In a word, everything. Six Flags has been hit with macroeconomic headwinds and some very company-specific problems, creating a perfect storm of poor attendance. Back in August, the Wall Street Journal ran what I can only call a very depressing profile of the company's cascading series of problems, which resulted in a no-good, very bad, terrible quarter this past summer. Now, some of it's beyond the company's control. Earlier this year, Six Flags was hit with real bad weather, with severe thunderstorms, and I've got to tell you, some really brutal heat waves hurting attendance. Some of their locations even had to shut down for multiple days at a time. This happened early in the season, which is when these companies usually sell those lucrative seasonal passes. At the same time, Six Flags has definitely been hurt by the declining health of the consumer, especially the lower-income consumer. These regional theme parks are seen as more cost-conscious vacation options than, say, going to Disney World, which is far, far more expensive. But because Six Flags is more levered to lower-income consumers, they feel more pain,
the house of pain,
when things get tougher. So attendance is going to get hit. No matter. This would be a bad environment for Six Flags no matter what, but it's not like they've been handling the situation that well. The Journal profile in August mentioned a new ride called Siren's Curse at the Cedar Point amusement park on the shores of Lake Erie, just west of Cleveland, forming the crown jewel of Cedar Fair's portfolio. The ironically named Siren's Curse was supposed to be an important new draw, but it ended up breaking down several times throughout the summer. One incident in July left riders stranded over 100 feet in the air. No one was hurt, but the story went viral. Not exactly good advertisement. In another example, it's a bit closer to home. Six Flags announced last November that it would tear down a few different rides at Six Flags Great Adventure in New Jersey and replace them with new ones that were to be open in 2026. But this July, the company announced that the replacement rides in the New Jersey park won't open until 2027. We've seen similar delays at Six Flags parks in Massachusetts. Operational issues. On top of that, management hasn't quite delivered on some big promises they made at the time of the merger. While Six Flags has pushed through some layoffs and cost cuts, there was supposed to be this revenue boost from selling season passes for the combined Six Flags Cedar Fair. Almost a year and a half into the merger, and we're not seeing any meaningful benefit to the company's attendance or overall business. Whether you want to attribute it to the broader economy or to company-specific execution issues, attendance at the parks has just been awful. In August, Six Flags reported that attendance for the combined company was down 9% year over year during the second quarter. When attendance is down, fewer people pay up for the fast passes that let them cut in line. It's just not worth it if the line's not particularly long. At the same time, fewer people means weaker food and beverage sales. Put it all together, it translates into a big earnings. And these things are really levered to what happens if you get a lot of people in and they're not getting them in. What makes this so much more worse? Six Flags has a terrible balance sheet. That's why the stock's really obliterated. Both Six Flags and Cedar Fair went into a merger process with a fair amount of debt. And the current Six Flags now has a sky-high leverage ratio of 6.3. Anything above 3 is considered high. Anything above 4 is very high. And anything above that is, well, let's just say Precarious? Now, in August, after Six Flags reported a putrid second quarter, we learned that CEO Richard Zimmerman will be stepping down at the end of the year. He'd done a good job at Cedar Fair before the merger, but at this point, investors are glad to see him go. Since then, they've been looking for a successor, and this is where the Travis Kelce connection comes in. On October 21st, Jana Partners, which is a big activist investor firm, announced that it had partnered with Kelce and a couple of other individuals, taking 9% stake in Six Flags. Now, is Kelce really that involved in this whole deal? I have no idea. But with the Chiefs at 6-5, currently on the playoff bubble, and a big wedding to plan with Taylor Swift, I doubt he's got too much time for Six Flags. But it's still a fun story. And for what it's worth, that Jana Partners announcement got plenty of attention, perhaps because Kelce's name was included. The stock popped nearly 18% on the day that the news broke. Unfortunately, those gains were short-lived, in large part because a couple weeks later, Six Flags reported a dismal third quarter. The good news, attendance was up in the third quarter, albeit only about 1%. The bad news was everything else. First, Six Flags said that after a strong performance in July and August, attendance trends moderated in September. And for the 5-week period ended November 2nd, attendance was down 11% year over year. That's heinous. Sales and earnings before interest, taxes, depreciation, and amortization both missed expectations. And for the second quarter in a row, Six Flags slashed its full-year EBITDA forecast. That is brutal. Now, this morning, we got some interesting news, though. Six Flags is bringing in John Riley from Palace Entertainment US as the next CEO, effective December 8th. Before that, he worked at SeaWorld. He's got some terrific turnaround experience in the theme park business. Jana Partners put out a statement in support of the hire. So back to the original question, can Travis Kelce save Six Flags? Obviously, it's a little tongue-in-cheek. The real question is whether Jana Partners, in combination with Kelce, can help save Six Flags. And the answer, only if the company lets them. Jana's got a great track record. Maybe Kelce can rope in Taylor Swift's legion of fans on top of Chiefs fans. Given that they like the new CEO, I'm feeling a little more optimistic about Six Flags, especially with gasoline prices coming down hard. That said, it certainly won't be easy because right now this company is a disaster. Before they can turn anything around, they desperately need to clean up the balance sheet and maybe close some more underperforming parks. Here's the bottom line. While Six Flags' new management should be able to turn things around with some help from Jana Partners and Travis Kelce, I wouldn't stick your neck out in this one unless you're willing to be incredibly patient because it's going to take a while and there's always the chance that the company itself can't make it if the weather's bad or the parks keep having operational issues. Let's take some calls. Let's go to Michael in West Virginia. Michael.
Booyah, Jim. Mad Mountain Money Mike here. How are you tonight?
Well, I am doing well, Mad Mountain. How can I help you?
Well, I've been reading this wonderful book, How to Make Money in Any Market, using it in this tricky market. Back in July, I needed some caffeine. I bought an OK cup, KDP, Jim. Am I in good shape there?
Yeah, I think you are. They're cleaning the thing. Oh, by the way, thank you for those nice comments about how to make money in any market. They're doing some good things. The stock is down huge. Yields 3.3%. I think that's a safe yield. I would actually join you in that. We did a piece saying that maybe this is finally the bottom, and I think it very much is. And thank you for the kind comments. All right, I'm still optimistic Six Flags can turn things around, but they need to lean into the support from Jana Partners and from Travis Kelce in order to make things happen. Now, much more made money at it. Last week, we covered some dividend stocks that were worth watching in a volatile tape. And with an over 5% yield, does Kimco fit the bill for your portfolio? I'm checking in with the CEO. Then you can't forget what really slays bull markets. I'll reveal what it is and why I worry we might be getting near there. And, of course, all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer. Last week, I spotlighted a trio of high-quality companies with dividend yields north of 5%. Because, look, it's a tricky environment. You can do a lot worse than owning stocks that can consistently generate that kind of income. Even though the market roared today, I still like the idea of dividend protection here. It's not always going to be as great as today. Which brings me to Kimco Realty, this shopping center real estate investment trust with a 5.1% yield. Late last month, Kimco reported a nicely better than expected quarter, raised its full-year funds from operations forecast. That's the REIT equivalent of earnings. However, the stock's been drifting lower ever since to the point where it's now down nearly 13% for the year. Could this be a buying opportunity? Let's check in with Connor Flynn. He's the CEO of Kimco Realty Corporation to find out. Mr. Flynn, welcome back to Mad Money.
Great to see you. Thanks for having me.
All right, so people have to understand, I do get to speak to the guests periodically ahead of time. Connor, you know I think that you're absurdly priced. And the reason I say that is because I'm looking at the fundamentals. I'm looking at what you're doing with your own stock. I'm looking at who your tenants are. So to me, what's wrong is the stock price.
Well, I appreciate that. I mean, at Kimco, we're very focused on what we can't control. And if you think about beating and raising 3 times this year, buying back stock, raising the dividend, the inflection point in Q3 is interesting, actually, because that's when occupancy ticked up, not just for Kimco, but the whole sector. And you're seeing that supply and demand setup where it really benefits high quality retail owners. And Kimco is well positioned for that change where you're going to see, I think, fund flows shift at some point, and we're primed for growth. We're built for cycles, but we're primed for growth.
Well, let's go over first. I agree with that, but I want to dig deeper. Go over first the way things have traded in REITs, in that once they catch fire, they move almost like tech stocks.
Yeah, it's like tides, right? The fund flows have so much impact, right? And so when you've got 80% of fund flow dictating share price, when 90% of all REITs are trading out of favor and like below book value, you focus on what you can't control. We got an A- balance sheet. We were one of only 2 shopping center REITs to do 5% earnings growth last year. We're on the way to do 6% this year. So when the fund flows change, there's going to be interest in resilient cash flow and where the consumer is focused on spending money. And I think that's where Kimco is perfectly positioned. What's working today is value proposition, convenience, and that's where Kimco is at the intersection.
I like that you rebut the things that are considered to be negative. For instance, the idea that e-commerce is going to destroy you.
That was the first hurdle we had to clear, I think, about a decade ago. You saw Walmart finally announcing that they've made e-commerce profitable, which is Walmart, obviously taking a lot of time and effort and money to make that profitable. And why is it profitable for them? They're delivering from their store base. They're using their physical tools to go and deliver what the consumer wants, and they're reinvesting in the store base. And that's what most of our retailers are doing today. If you look at the top 10 e-commerce retailers, they're all Kimco tenants in our shopping centers.
Absolutely.
It's clearly the vision of the future is utilizing your store base to deliver what the consumer wants and needs at their option.
All right, so then the next one. Well, because I'm going right down, because that's what you do when you try to figure out why it shouldn't be at 5. Well, hold it. Party City, Joanne, Big Lots, Rite Aid. Wow. Danger.
That was the overhang at the beginning of the year, right? That's where, the retail apocalypse is coming, all these bankruptcies. These were what we call Chapter 22s. They've filed bankruptcy before, they're filed bankruptcy again, and literally all of those hit in Q1, and we're doing 6% earnings growth this year. And the backfills of those spaces, and that's the supply and demand dynamic that I'm talking about, on average, 40% higher rent on the backfill tenants. And it's a better credit tenant. It's TJ Maxx. It's Ross, it's Burlington.
Well, it's funny.
It's like all the value. It's like where everybody's shopping.
What I was going to say was perhaps, because I am doing straw men here, perhaps it's a concentration of stores that I wouldn't like, and I don't like their stocks.
Right, I know, it's true.
Except for it's every stock that I like. I mean, it really is fun. TJX is one of the largest stocks in my Travel Trust, and Ross, Burlington, Whole Foods, of course, Amazon. So it's obviously not that. Then people say, well, wait a second. You happen to have some real estate that's actually apartments. Now that must be hurting them.
I mean, the nice part about our business is we have all this embedded value that we're unlocking. So parking lots for us, we think of as like future upside, and that's where we're entitling the right to build apartments. And so down by where you're from in Suburban Square in Ardmore, Pennsylvania.
Oh, I know.
We're going to deliver that next year, and it's going to be an absolute amazing project where, again, retail is the amenity base because that's the shopping center, and it enhances the apartments. Because think about an apartment building. What do they try and do on the ground floor? Maybe they're able to offer grocery. Maybe they're able to offer a coffee shop, maybe a fitness user. We have typically, on average, all of those and 100 other tenants in a shopping center.
So then perhaps people might say, and this is the last of the straw men, there's overbuilding in the strip mall business.
So 13 years of no new supply, 0.3% of existing stock under construction. There's more office being built than retail today.
That's incredible. And I know that there's always these, look, where is a ReadyCare clinic going to go, right? I mean, what happens when all the drugstores that are closed are re-tenanted? Then there's nothing left.
So that's what we see actually is the resiliency of the economy today. Like traffic is up year to date. Right. You see small business formation up. That's all those small businesses that are filling in between the grocery store and the off-price player like TJ Maxx or Marshalls. And you're seeing urgent care, pediatric urgent care, dentists, doctors, you name it. And it's all about convenience. And most people live near where the shopping center of Kimco's ownership is, and that's where it's convenient to shop.
Now, you are a great operator, so I'll ask this question. You wouldn't know unless you were a great operator. What's the feeling for the consumer? What's the feeling for the Christmas holiday?
So most of them are focused on value, right? Making their dollar go further. And there has been a lot of, like, in terms of impact of inflation on the lower demographic tranche. And so what we're trying to focus on is offering the consumer value when they come to a Kimco shopping center. And that's where you're seeing that dynamic of
regardless of the holidays.
Exactly. So like it's essential goods and services, right? That's what Kimco delivers. So maybe you're buying your turkey for Thanksgiving at a Whole Foods or a Trader Joe's or a Sprouts, you name it, all of the grocery anchors that we have. But then you're also probably going to shop at TJ Maxx for maybe some Christmas gifts that are offered on value. And that's the beauty of our shopping centers. You can do the essentials plus. And I think that's where we're well positioned for the holiday.
Now, the one last confusion that I have is that I've seen the REITs do badly when rates go higher, but actually that's not happening either.
Yeah, it's one of those. It's the long end of the curve, right? That most people their bonds are priced off of. So you're going to probably start to see maybe some shifts in interest rates. Maybe if the Fed chair in time changes and they take a different tack, right? That could be a catalyst.
Well, that's the reason. Like people are buying gold and selling these because people feel that there's going to get very easy because of President Trump. I would come back and say in the ultimate group defense is every time it's been a huge buy.
I mean, there's not many sectors out there with virtually no new supply, pricing power, earnings growth, and the one disconnect is your cost of equity. And so when that comes back, all of a sudden you should have external growth layered on top of all this organic growth, because we've got in our signed but not open pipeline $71 million of NOI, which is close to 5% of our NOI, sitting waiting rent commencement, meaning like it's not flowing yet. So that's visible earnings growth in the future that's literally just sitting there about to come online in 26 and beyond. So we feel pretty good about our setup that, hey, focus on what we can control, execute like crazy, and the tides will change and Kimco will be back in favor soon.
And I think everyone, especially people who are in their 50s, 60s, 70s, should be thinking about a 5% yielder to replace a high flyer. So I want to thank you for coming on and explaining everything really well. That's Connor Flynn, CEO of Kimco Realty, KIM. What can I say? I'm a huge believer. It's been right to be.
Appreciate it.
Mad Money's back here.
Coming up, Cramer takes your calls, and the sky's the limit. It's a fast-fire lightning round. Next.
Before we get to your calls, guess what? Christmas came early. There's a special offering happening right now to join the CNBC Investing Club. You're going to get my top takeaways and every charitable trust move, of course, before I make it. Scan the QR code or go to cnbc.com/Cramer Club. And now it is time. It's time for the light round. Here's my friend Rob Close. I'm saying the stocks that are buy, sell, jumping to the callers ahead of time. My staff is where you plan this out. And then the lightning round is over. Are you ready, Ski Daddy? Time for the light round, cameras. Let's go to Kim in New York. Kim.
Hi, Jim. I'm so excited to speak to you. I'm a new club member, and I'm loving it. I bought this aerospace stock in 2014 for $31 a share, and today it's $200. But revenue is up 14% year over year. So should I sell or hold? The company is Hownet Aerospace.
Okay, I want you to hold Howmet. I think it's probably the best performer in the industry. It's going up even as its major customers are not doing that well. Can you imagine what happens when the customers start doing well? I say hold on to Howmet. Let's go to Leslie in California. Leslie.
Jim, I have a subscription to the Journal of Portfolio Management, so I'm a real academic guru. But making money in any market is better than that subscription.
You're very kind.
Technology Group.
Okay, Marvell is a winner when we talk about this non-NVIDIA, who makes chips for themselves kind of thing. And Marvell is a very good stock. There's a lot of takeover fluff in it. I want to wait for that fluff to be taken out of it. I'm not going to recommend the stock up $6. Let's go to Jack in California. Jack.
Hey, thanks for all the good advice on Apple. You've made us all a lot of money. I appreciate it.
You're very kind. Thank you.
The stock I have is a wild stock. Over the last 2 years, gone from 40 to 170, back to 90 when the short sellers got after it, back to 180. Everybody loves it on Wall Street. I can't understand why it's not higher. They just finished a big a deal with Apollo, FTAI, aviation.
I like it too. It's aviation. But remember, aviation is not doing as well as the companies in travel. And that's what's hurting FTAI. I want you to hold on to it, though. Let's go to Jay in Arkansas. Jay.
Booyah, Cramer.
Booyah.
Hey, Jim, I have this stock that's been on my watch list for quite a while now. I missed the most recent parabolic swing. The company has triple-digit revenue growth quarter after quarter. They have robust margins. My stock is Astera Labs.
You know, look, it sells at 82 times earnings. I mean, it's the most highly valued stock in the entire stock market. I cannot get behind it at these prices, even though I think it's a very, very good company. Let's go to Sam in Illinois. Sam.
Hi, Jim. Thank you for taking my call. My stock tonight is Jacobs Solutions.
Okay, let me just say right now, Jacobs Solutions, I think, was incorrectly valued last week when an analyst came out and said that they did not do the number and did not do the forecast. That was not true. Bob Pragada did the number, and he gave a good forecast, and that's why I think that Goldman Sachs recommended today. I can't speak highly enough about both Jacobs and the price that it's at. I would buy this thing at 132. Let's go to Mark in Arizona. Mark.
Jim, warm holiday booyahs from the desert.
Thank you, you too. Thank you for that. What's going on?
Jim, there's been a landslide at Iron Mountain, and I'm getting crushed. What am I going to do from here?
Yeah, I mean, people are really trying to rethink. That stock's being rethinked on the fly and in a very negative way. I think it's got a 4% yield now. That'll probably hold. But if it rallies at all, I do want you to sell it. I just don't see the upside. Let's go to Anthony in Florida. Anthony.
Booyah, Jim.
Booyah, Anthony. What's up?
I have ticket symbol RKLB. I've been a buyer since $6. I know in your book that you wrote how to make money in any market. You talked about speculation, but doing it wisely. I believe this company has a lot of potential with.
Okay, look, I have to tell you, I think this stock is very, look, as these stocks go, I'm not going to call it inexpensive because it's a spec, but as specs go, I like it at these prices. How about that? I think that's a fair way to put it. Let's go to John in Virginia. John.
Jim, I'm asking about one of the leading companies in the nation's capital, Booz Allen Hamilton, BAA.
This Booz Allen Hamilton got hurt very badly by Doge. Now, Doge has since moved on, so to speak, and I think all the way down here, it sells at an incredibly low multiple. I'm going to take the other side of the sellers and recommend the stock. Let's go to Nathan in Texas. Nathan.
Jim, how are you, buddy?
I am good. How about you, Nathan?
I'm great. It's good to talk to you. IMCR, Immunocare.
Yeah, you know what? I'm going to have to. I have to look at what the heck's going on there because that just had one of the biggest moves. We're going to wait on that. Let's do some work on that. Let's go to David in California. David.
Hey, booyah, Cramer from South End of the Golden State. Love you, man.
All right. Good to have you on the show.
Thank you. Neptune Insurance Holdings.
You know, the only insurance company I recommend is Chubb. I am intrigued by this lemonade. I read another good report about it today. I do think that it's become the way for younger people to trade the whole complex of insurance, and it's up another 5 today on a very positive recommendation. It's probably not done. Let's go to Kirk in Texas. Kirk.
Hey, Jim, it's Kirk.
Hey, Kirk, what's up?
Oh, so I was watching the market just rip higher today, and I noticed that Spotify was down by 2%.
Yeah, that made no sense to me. I looked at Spotify, too. I don't understand why it's not coming back. It's a great subscription business, and I think you ought to buy the stock. And that, ladies and gentlemen, is the conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab. Coming up, there's one big factor that could put this bull market in jeopardy, and it's as simple as supply and demand. Cramer's explaining next.
Booyah for the Emperor of Cramerica.
Honorable James J. Cramer.
You got me jumping around my office right now.
Thank you so much for all you do for us.
I enjoy your show and I find it very entertaining and informative.
I watched your first ever episode of Mad Money back in 2005, and I've been watching every single episode ever since.
Don't miss Mad Money every night at 6 p.m. Eastern. Plus, join the CNBC Investing Club and stick with Cramer around the clock.
Never forget what really slays bull markets. Supply. Once we have more supply than we can handle, we're headed straight to the slaughterhouse. And I worry that with lots of insider selling and a slew of IPOs, we could be getting there. The biggest source of supply is underwritings. According to data from Renaissance Capital, the IPO research firm, we've had 194 IPOs this year, up almost 50% from the same date last year. These new deals amount to total proceeds of $36 billion, which is already up from the $29 billion total from all of last year. Not monumental, and much smaller than the $142 billion worth of IPOs we had in 2021. A bear market has many fathers. But I'd tell you that the oversupply in 2021 contributed vitally to the bear market in 2022. Still, these new deals are worth watching because many of the biggest IPOs took place earlier in the year, which means insiders can now sell their stock. And again, that's a huge hidden source of new supply, as that supply was locked up when the companies came public. The quality of some of this year's largest deals is certainly questionable, at least as judged by the market. The largest deal, a $1.75 billion offering from Venture Global, a liquefied natural gas infrastructure play in January, has been very disappointing. The company raised $1.75 billion at $25 per share. It's now just over $7. That's disastrous. CoreWeave raised $1.5 billion at $40 per share. With the stock now at 73 and change, you can still call that a win, although this thing's way down from 187 at its peak over the summer. Figma, the enterprise software company, raised $1.4 billion at 33. It's now at just over 35. This one got up to nearly 143 at one point on its second day of trading before losing most of its value, the definition of a round trip. SailPoint raised $1.38 billion. This is a cybersecurity identity stock that came public at 23, and it's now down to $18. Rounding out the top five, Circle Internet Group raised $1.2 billion at 31, and it's at 72. The biggest winner in the group. Circle's a digital asset story, and if companies ever choose to do business using crypto as an actual currency, it could be an even bigger winner. But even this is way down from its highs. Overall, the IPO class of 2025 is a decidedly mixed bag. How about the insider selling? Well, we just learned that Dylan Field, the CEO of Figma, sold $113 million in shares. A bunch of Circle insiders sold stock, but not huge amounts. A host of executives sold stock for SailPoint, including CEO Mark McClain, who unloaded $10.5 million worth of shares. Michael Intrater, the CEO of CoreWeave, has sold about $84 million worth of stock since his lockup expired, which is admittedly a very small part of his holdings, though. Why are these insider sales so important? Because we're always looking for signs that we might be on course for a dot-com style scenario, where insiders were dumping stock furiously because they knew that their stocks were ridiculously overvalued and they would never make the rosy projections. They knew that the internet was not turning out to be as bountiful as they'd hoped. We have nothing like that now, although we still have too many deals for my taste. Let's leave it like this. You get too many deals, you get too much real turmoil. We don't have that yet. But stay vigilant. While we're getting too much new supply, and it makes me nervous, it's still a long way from what we saw during the 2021 or the dot-com collapse. I like to say there's always a bull market somewhere, and I promise I'll find it just for you right here on Mad Money. I'm Jim Cramer. See you tomorrow.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.